It just happened right at the open, not during panic and not during breaking news, but at the exact moment the market was supposed to be calm. Silver did not fall, it was forced lower. This was the kind of move professionals do not explain away, the kind that leaves patterns, raises timing questions, and creates questions no one wants asked. Because when markets move like this, someone is protecting something and someone else is exposed. What follows is not opinion, it is behavior, and behavior always tells the truth. Stay with this analysis, because by the end, the silver crash will look very different from the headlines, and its meaning will extend far beyond silver. Welcome to the currency game. This channel exists for those who have lived long enough to see markets repeat the same mistakes, and for those who understand that systems promise stability yet deliver surprises. If that sounds familiar, consider subscribing, not for trends, but for clarity, because understanding money today requires patience, experience, and perspective. And before continuing, let us know where you're watching from, because markets are global, and the audience that understands them usually is too. The silver market has experienced declines before. Prices rise and fall, and that alone is not unusual. What made this event different was not the size of the move, but its timing, its speed, and its behavior. At the COMEX Open, markets are designed for orderly price discovery. Liquidity is present, participants are active, and moves are expected to reflect information. This move did not. Silver dropped sharply at the open, pulling gold with it. There was no major economic release, no sudden geopolitical shock, and no unexpected data. Yet the selling was immediate, concentrated, and precise. Professionals do not judge markets by price alone. They observe how price behaves through volume, velocity, and response. In this case, the selling arrived in bursts, with large orders appearing quickly during a moment that maximized impact. This was not panic. Panic is disorderly. This was controlled. When organic selling occurs, buyers emerge gradually and price seeks balance. Here, price collapsed and then stabilized almost mechanically. That behavior matters. Markets reward someone and punish someone else with every move. When a move is this sudden, the important question becomes simple. Who needed silver lower at that exact moment? Common explanations fall apart quickly. Profit-taking is gradual. Hedging is spread over time. Rebalancing does not strike precisely at the open. This did. That is where normal market logic begins to fail. Seasoned participants recognize this pattern. They have seen it before, in currencies, bonds, and commodities, a sharp push at a visible moment, followed by quiet stabilization. The objective is not optimal selling, it is behavioral impact. Such moves trigger stop-loss orders. They pressure leveraged positions. They remove weak hands. Confidence shifts. The market appears to recover, but something underneath has changed. This is why serious analysts study behavior instead of headlines. Fundamentals do not move suddenly. People do. Another detail, intensified concern. The selling did not resemble normal Western trading patterns. It aligned more closely with Asian market hours. That distinction is important. Asian sessions often carry thinner liquidity for Western contracts. Price moves further with less resistance. This is not coincidence. When liquidity is thin, leverage becomes powerful. Smaller capital can produce larger effects. The timing suggested structure, not emotion. Then came the signal most people missed. While Western markets absorbed the price drop, an official notice emerged from Asia, not speculation, a formal exchange statement. The notice referenced abnormal trading behavior, accounts exceeding limits, restrictions being applied. Exchanges avoid such admissions. They prefer confidence and continuity. When they speak publicly, it is because silence poses greater risk. This notice transformed uncertainty into context. It did not explain everything, but it confirmed one fact clearly. This was not routine. For business leaders and entrepreneurs, this matters. Silver is not just a metal, it is a financial signal. It reflects trust in currency systems, credit, and confidence. When silver behaves unusually, pressure often exists elsewhere. This event was not about jewelry demand or industrial usage. It was about positioning, exposure, and control. Markets rarely warn loudly. They whisper first. This was not a scream. It was a whisper, heard only by those trained to listen. And the question now becomes unavoidable. If such force was required to move silver, what pressure was being relieved somewhere else? To understand what unfolded, one must separate price from reality. In modern commodity markets, the two often diverge. Silver trades in two worlds at the same time. One is physical, metal that must be mined, refined, transported, and stored. The other is financial, contracts, leverage, promises, and timing. The crash did not originate from the physical world. No sudden surge of silver entered warehouses. No discovery reduced scarcity overnight. Industrial demand did not collapse. Yet the price moved violently. That contradiction is the first signal. In paper markets, control is achieved through structure, not supply. Futures contracts allow large exposure with limited capital. This leverage magnifies impact, especially during moments of predictable liquidity. The COMEX Open is one of those moments. At the open, bids and offers are visible. Stops are clustered. Algorithms are active. A well-placed surge of selling can trigger a chain reaction. This is not theory. It is mechanics. When a large sell order hits suddenly, it pushes price into known technical zones. Those zones contain stop-loss orders placed by leveraged participants. Once triggered, those stops become market sells. Selling creates more selling. The initial actor does not need to unload everything. They only need to push the first domino. This is how paper markets move faster than fundamentals. Importantly, such moves are not designed to achieve the best sale price. They are designed to force others to sell. That distinction is critical. A rational seller seeks liquidity and patience. A strategic seller seeks reaction. In this case, the speed of the decline suggested the latter. Another factor amplified the effect: timing. The move began when Western participation was muted and Asian liquidity dominated. During these hours, fewer participants absorb shock. Price moves further with less resistance. Professionals understand this. They do not choose timing randomly. The use of leverage adds another layer. In silver, leverage is widely used. Margins are thin. Price sensitivity is high. And when price drops sharply, margin calls follow. Participants must either add capital or liquidate. Liquidation adds pressure. This is not about belief or narrative. It is about arithmetic. A 5% move against leverage can wipe out positions built over months. Forced exits create the illusion of consensus. But it is not consensus. It is compulsion. Critically, none of this alters physical supply. Warehouses do not fill overnight. Delivery queues do not disappear. This is why experienced analysts dismiss the idea that such moves reflect genuine market agreement. They reflect mechanical stress. The concept often misunderstood by the public is this: paper markets do not exist to reflect reality. They exist to manage risk and transfer exposure. When exposure grows uncomfortable, price is used to relieve it. That is why sharp declines often occur without news. The news is internal. Another detail reveals intent, the rebound. After the initial collapse, price did not continue lower naturally. It stabilized. This suggests the objective was not prolonged selling. It was impact. Once stops were cleared and leverage removed, the urgency vanished. The move had done its job. This pattern repeats across markets. It appears in bonds during yield stress, in currencies during reserve defense, in commodities during inventory strain. It is always the same logic. Pressure exists. Price is used to release it. For business leaders, this has broader meaning. Markets that require such interventions are not stable. They are managed, and managed systems depend heavily on confidence. When confidence weakens, the tools become more visible. This event demonstrated that silver's price is not just a reflection of demand. It is a pressure valve within a larger financial structure. That structure includes debt, currency trust, and leverage across asset classes. When one area tightens, another is adjusted. Silver, because of its dual role as both industrial metal and monetary signal, often absorbs stress meant for elsewhere. The decline was not random. It was targeted, timed, and limited. These characteristics separate normal volatility from engineered movement. The question is not whether this was allowed. Markets allow many things. The question is why it was necessary. Because necessity implies constraint, and constraint in financial systems always points to deeper imbalance. That imbalance does not resolve itself through price suppression. It only relocates. Which raises the next concern. If pressure had to be released here, where was it building before the release? Markets do not exist in isolation. They operate within layers of jurisdiction, regulation, and institutional tolerance. When unusual behavior occurs, the most important signals rarely come from prices themselves. They come from how institutions respond. This is where the silver event moves from suspicion into significance. The timing alone raised questions. The selling pressure emerged during hours when Asian markets carried greater influence over price formation. This was not incidental. Asian trading sessions often operate with different liquidity characteristics than Western hours. Participation is narrower. Order books are thinner. Price sensitivity is higher. For actors seeking maximum impact with minimal exposure, this window is strategic. But timing by itself is not evidence. Institutions respond to evidence. What followed mattered far more than the price action itself. An official exchange notice emerged from Asia. Not commentary, not speculation, a formal statement. Such notices are rare for a reason. Exchanges exist to project confidence. They are guardians of orderly markets. Their public language is carefully chosen, often restrained to the point of opacity. When an exchange acknowledges abnormal trading behavior, it is not an admission made lightly. It is a signal. The notice referenced multiple accounts acting under common control. It cited breaches of daily thresholds. Restrictions were applied. This language matters. Common control implies coordination. Not independent actors responding to market conditions, but related entities acting with shared intent. Threshold breaches imply speed and scale beyond acceptable norms. Not gradual positioning, not hedging. And restrictions indicate that internal safeguards were triggered. Exchanges tolerate aggressive trading. They tolerate volatility. They tolerate losses. What they do not tolerate is behavior that threatens market integrity or exposes systemic risk. This is the critical distinction. If the event were routine, no notice would be necessary. Markets fall every day. But when behavior crosses into destabilizing territory, institutions intervene quietly. The quietness itself is revealing. There was no press conference, no headline explanation, just a controlled acknowledgement. This suggests the goal was containment, not disclosure. For experienced observers, this raises a deeper question. Why now? Institutions do not act unless incentives shift, either risk increased or tolerance decreased. In many cases, both occur simultaneously. Another factor adds weight to this interpretation. The acknowledgement came from Asia, not the West. This implies that pressure was not evenly distributed across jurisdictions. Some markets felt it sooner. Some institutions reacted faster. This geographic asymmetry is common in periods of systemic stress. Capital flows do not move uniformly. Neither does risk. When one region tightens, others adjust. When one exchange restricts behavior, it often reflects concern that actions elsewhere may soon follow. Importantly, the notice did not accuse individuals. It did not assign blame. It described behavior. Institutions speak in behavior because behavior is observable. Intent is not. But in markets, repeated behavior reveals intent over time. This is why professional analysts study regulatory language closely. They look for deviations from standard phrasing. They examine what is said and what is omitted. In this case, what was omitted was reassurance. There was no statement that markets were functioning normally, no declaration that price discovery remained healthy. Instead, the notice focused on control measures. Control measures are not about prices. They are about risk. Risk to participants, risk to settlement, risk to confidence. Confidence is the foundation of all financial systems. When confidence erodes, institutions act preemptively. The silver market, though relatively small compared to equities or bonds, plays an outsized signaling role. It sits at the intersection of industry and money. It reflects trust in currency regimes, not just supply-demand balances. And when institutions intervene around silver, it is rarely about silver alone. It is about what silver represents. Historically, periods of financial strain often produce similar patterns. Sharp moves in metals, quiet regulatory responses, geographic inconsistencies. These patterns do not resolve immediately. They evolve. For business leaders and entrepreneurs, this matters because institutional behavior precedes visible consequences. By the time stress becomes obvious, options narrow. Risk management becomes reactive instead of strategic. The exchange notice did not explain everything. It did not need to. Its purpose was to draw a line indicating that certain behaviors at certain times had crossed from acceptable aggression into systemic concern. That line is invisible to most participants, but it exists. And when it is crossed, the implications extend beyond one market, one metal, or one session. They speak to a system under pressure, one that is increasingly managed rather than organic, which leads to the most important question of all. If institutions are already intervening quietly, what are they preparing for next? By the time institutions intervene quietly, the real decision-making window has already begun to narrow. Markets do not wait for explanations. They respond to pressure. The silver event was not a warning aimed at retail traders. It was a signal directed inward, toward institutions, large capital holders, and those responsible for maintaining system stability. For entrepreneurs and business leaders, the relevance lies not in silver as a commodity, but in what forced intervention reveals about the broader financial environment. Systems that function smoothly do not require sudden force. They do not rely on precision timing to maintain balance. They absorb shocks naturally. When force becomes necessary, it suggests fragility. The modern financial system is deeply interconnected. Debt markets, currency markets, and commodity markets are not separate arenas. They are pressure-sharing mechanisms. Stress rarely announces itself where it originates. It migrates. Silver, due to its dual role, often becomes a release valve. It is small enough to move decisively, yet symbolic enough to send signals. This is why such events matter far beyond the metal itself. For capital allocators, the implication is clear. Price stability is increasingly managed, not earned. Managed systems depend on continuous intervention. Continuous intervention depends on confidence. Confidence, once questioned, becomes expensive to maintain. This creates a strategic dilemma. On one hand, intervention delays visible consequences. On the other, it accumulates hidden risk. Entrepreneurs operate at the intersection of capital availability and market confidence. They rely on credit, currencies, and predictable cost structures. When financial signals indicate stress, those assumptions deserve review. The silver event suggests that leverage sensitivity is rising, that margins are thin, that tolerance for volatility is shrinking. In such environments, sudden repricing becomes more likely, not less. Importantly, This does not imply immediate collapse. Systems often persist far longer than expected, but persistence should not be confused with resilience. Resilience absorbs shock. Persistence postpones it. Another implication concerns information asymmetry. Institutional actors receive signals earlier. They respond quietly. By the time narratives reach the public, positioning has already shifted. This places business leaders at a disadvantage if they rely solely on headlines. Strategic awareness requires reading behavior, not commentary. When exchanges restrict accounts, when markets move without news, when price action becomes mechanical rather than expressive, these are not isolated curiosities. They are indicators of constrained flexibility within the system. For long-term planners, this argues for diversification, not just of assets, but of assumptions. Assumptions about liquidity, assumptions about currency stability, assumptions about the availability of capital under stress. Periods of managed stability often precede periods of abrupt adjustment. The transition is rarely smooth. This is where decision makers must think in probabilities, not predictions. The silver crash does not predict a specific outcome. It increases the probability of disorderly adjustments elsewhere. Currency markets may absorb pressure next. Debt markets may require support. Risk premiums may reprice. None of these outcomes are guaranteed, but ignoring the signals increases exposure. Another lesson emerges around optionality. Systems under pressure reduce optionality over time. Choices that exist today may not exist tomorrow. Capital becomes selective. Terms tighten. Risk tolerance declines. Entrepreneurs who anticipate these shifts preserve flexibility. Those who do not are forced to react. The silver event is a reminder that markets often communicate in advance, quietly. It is not the crash itself that matters most. It is the need for it. The need suggests imbalance. Imbalance suggests mispricing elsewhere. For serious decision makers, the appropriate response is not panic. It is preparation. Preparation involves stress testing assumptions, reviewing leverage, evaluating exposure to currency risk, understanding how dependent operations are on uninterrupted liquidity. It also involves patience. Managed systems can appear stable for long periods, but when confidence finally breaks, adjustments compress time dramatically. Those who prepare early gain advantage not because they predict correctly, but because they are positioned flexibly. The silver market did not fail. It performed its role. It transmitted information. Information that those paying attention will recognize as a strategic warning, not of imminent collapse, but of increasing constraint. And in finance, constraint is often the precursor to change. The question now facing business leaders is not whether the system will continue to function tomorrow. It almost certainly will. The real question is simpler and more important. When the next adjustment comes, will they be reacting to it or already positioned for it?